Here's what Tiff Macklem didn't say when it came to the July 30th Bank of Canada rate announcement. The Bank of Canada is no longer making decisions on what the economy actually needs. It's actually making decisions based on what Donald Trump is about to do next with the US and Canada. This third consecutive rate hold isn't actually about inflation. It's about trade and tariff uncertainty. And if you have a mortgage in Canada and you've not been paying attention to my channel for the last couple of weeks, this signals a clear change to your financial strategy over the course of the next 2 years and possibly beyond. Today, I'm gonna break down exactly why they held interest rates, what this means for your mortgage going forward, of course, what this could mean for the housing market, and essentially how to prepare, whether you have a renewal, you're thinking about buying, or you just genuinely want to understand what's going on. Let me read the exact words to you from the Bank of Canada statement. With uncertainty about the US tariffs still high, the Canadian economy softer but not sharply weaker, and some unexpected firmness in recent inflation data, Governing Council decided to hold the policy rate as we gain more information on US trade policy and its impacts. Wow, that was a mouthful. The translation, they're playing defense and no longer playing offense. And the interesting thing is they actually gave us 3 potential reasons why they made this decision and 3 potential outcomes, which is more interesting. Let's dig right into it. Number 1, the trade war paralysis. The bank is literally waiting to see what trade policies emerge from ongoing US and Canada negotiations. This is wild. They're no longer making rate decisions based on Canadian economic fundamentals, and they've admitted exactly that. They're essentially reacting to the potential of different tariff situations going forward. Now, there was somewhat of an inflation surprise. Core measures have edged higher in 2025, driven mostly by building pressures among domestic services components. They thought it would bring down a softening in demand, but it didn't. The truth is, the third reason that this happened is that our economy, it's not strong enough to be able to handle a rate increase, but it's not soft enough to be able to see rates come down. The reality is the Bank of Canada right now is stuck in a state of limbo. What this really means going forward is that the Bank of Canada no longer has virtually any control over the monetary policy, which is insane. Trade uncertainty is literally what is driving Canadian mortgage interest rates right now. And if you don't believe it, let's dig right into it. So most people want to know where rates headed, and there's really a big split right now, mostly coming from the BOC itself. Here's where it gets really interesting. Even the major banks cannot agree exactly on where rates are going to go and where rates are going. And this disagreement tells you everything you need to know about the future of what to expect from the rate market. Let's start off with RBC. RBC suggested a very pessimistic view in the marketplace. They're breaking away from the pack, so to speak, and have taken additional cuts off the table, basically suggesting 275 is where we are going to stay. They're forecasting the overnight rate to stay at 2.75 all the way through 2026, and that makes them the most hawkish of the big banks. Optimistically speaking, on the other end, you have TD and you have CIBC. Now, TD Bank and CIBC, they still anticipate drops of at least 0.25% by the end of the summer, which is coming up pretty quickly here, and another 0.25% in the fall, leaving the overnight rate at 2.25% by the end of the year, which is a 0.5% rate drop from today. And then you've got a couple in the middle ground. BMO, for example. BMO forecasts 3 rate cuts in total. All of my variable rate friends out there are cheering for this one. July, October, and possibly one month later is what BMO is still predicting as of the most recent bank's forecast. But here's the reason that those different banks diverge. There's 3 different potential outcomes for them. Number 1, if trade tensions ease, they're suggesting that rate cuts could hit 2.25% by the end of 2025. If trade wars escalate, the rate stayed at 2.75%. So basically they stay where they are if the trade wars get worse. And inflation, if that goes up due to tariffs, there is a suggestion and a proposal, even though very few actually think this could happen, but there are some out there who are saying rates could actually go up in that circumstance. So experts are forecasting that rates could go down by 0.75% by the end of 2026, which is honestly probably pretty unlikely at this time right now. My take on the matter is that I still think there will be rate cuts, obviously subject to the craziness of the trade wars. But I think what's going to happen is it's not going to happen the way that we expect. I mean, let's be honest, the banks are never usually correct, and their outcomes have been delayed by this trade war in the first place. But there is the possibility and a higher possibility that relief is coming. And when it does, I think it'll be when most people don't expect it. Now, if you have a variable rate mortgage today, basically this means that your prime rate minus your discount, prime is 4.95%. If your discount is 0.5, you're still sitting at 4.45% today. And that is not changing. With the no rate cuts, there's no change to your interest rate, no change to your monthly payments. Even with the more optimistic suggestions of rates getting cut by 0.5%, that means where your rates are at today, your best case scenario is that rates go down 0.5%, because I think 0.75% is honestly pretty unlikely at this time. But the big question is, for that huge tsunami of people who are renewing their mortgage in the next 12 months, what exactly do those people do? This is where the math can get a little bit more painful. Current 5-year fixed rates today are around 4.5 to 4.75% at most major banks. Some a little bit lower, some a little bit higher. If you locked in at 2.5% or 2% in 2020, you're looking at anywhere between a $700 to $800 increase in your monthly payments based on that $500,000 mortgage. Here's where the opportunity is. Fixed rates are not in concert with the Bank of Canada. And if you've been paying attention to my content, you know that the bond yields have been going up for the better part of the last 30 days, forcing the fixed rate market up. Today's Bank of Canada rate change or rate hold basically means that most fixed rates and most variable rates are within 0.25% of one another. There is a unique opportunity right now where people can lock in or refinance or re-amortize, which is to extend their amortization to basically lock their payments down at current interest rates before they go up. The market's projecting the bond yields to go up for the course of the next 3 to 5 years, which basically the outcome is expected to be an average interest rate of 5.5% on the fixed rate market, even if variable rates go down. Here's the framework if you have a mortgage renewal coming up. If you're up in the next 120 days, get a rate hold today. We can lock in for 120 days. If you're up in the next 4 to 12 months, consider getting a rate hold now and paying out the interest to maturity if you're in a situation where the rates have gone up from the time that you lock in. If you're beyond 12 months, honestly, it really depends on your personal financial situation. If you've got a lot of debt that you're carrying or your lifestyle is going to change significantly, then it's always a good time to reach out to have that kind of consultation, but there's no immediate action required. But here's where things get interesting. The bank's second quarter business outlook survey suggested that many firms are opting to absorb higher costs from tariffs rather than pass them over to consumers. This creates a window where economic conditions may soften without inflation actually spiking. So the big question is on timing, and depending on whether you believe CMHC based on their last housing report, or if you're looking at the Bank of Canada and what's happening in the tariff market, if you're qualified and you find the right property, I would say buy now, if not only for the sake that you're going to be able to secure a piece of real estate, but you're buying at something close to a softening of the cycle or a near bottom of the cycle. Rate timing is less important than market timing because price appreciation usually overtakes the rate savings, especially in that market. And for those who are still waiting on the fence right now because they expect rates to go down in order to buy, not the right timing. Now, in some markets, you may still continue to see a softening as consumer confidence may be negatively impacted with the bank not dropping rates. The argument is that most markets are starting to move along a little bit more of a steady pace, finding a balanced market, with the exception of a few gaps like those high expensive condos in downtown cores. So here's the scenario that could absolutely blow out everybody's forecast on the marketplace. What if tariffs actually cause sustained inflation and not just one-time price increases like we've seen to date? The Bank of Canada expects tariffs to cause a one-time increase in prices that should stabilize at that higher level. They don't want to see price increases become more broad-based. Basically, they don't want to see this inflation continue at its current capacity. But what if this happens? Here's what this could look like. In this case, we would be looking at rate increases, not decreases. And that should scare you. So here's what the BOC is looking for. Number one, they're going to monitor core inflation data monthly. If the trends are above 3%, rate cuts are basically going to be completely off the table. The second thing they're looking at for, and you can look for this, is watch the Canadian dollar. If it weakens due to trade tensions, inflation imports, they might get worse. The dollar gets worse. Third thing that you should be looking out for, and the BOC is looking out for, is paying attention to wage growth in this marketplace. If tariff-induced price increases continue, this means that we can see a wage price spiral. And that is not a good thing in this market. Here's what to do in this worst case scenario. Number one, build a buffer. If you're in a variable rate mortgage or you're in a fixed rate loan coming up, you need to really think about having some type of a payment buffer in your current budget. Number two, consider a fixed rate over a variable rate. Now, not just any fixed rate, you need to be considering one that has a high level of flexibility to pay things down, maybe re-amortize your loan to keep your payments as low as possible and make sure you have a high prepayment capability with limited functions. This will allow you to avoid the potential rate hike increases if that were to happen. And the third is, honestly, don't over leverage yourself. Don't borrow too much money to a point where you're at your maximum capability. The good news is the total debt to income ratios have come down recently. And you should really be careful to watch out for that. So cutting to the point, what actually do you do right now? Number one, we've talked about this before. Renewing in 2025, get your rate quotes now. Consider shorter terms, maybe 3 years to set yourself up for success and create some flexibility while we get through all of this. And number three, stress test your budget payments in a higher rate cycle to make sure that you can make those increased payments. And if you can't, consider some type of a payment relief. We have options that we can look at for that. If you're on a variable rate, assume there is no payment relief coming right now. If it does, it's a bonus. But act as if payments will remain the same for the next 1 to 2 years and have a worst case scenario if payments were to go up, and be prepared for that to happen. And if you're buying right now, focus on property fundamentals, not timing the freaking market. It's never worked out for most people before, and it probably won't work again. Final thought on all this is that evidence is real. The bank has made their decision. I think the biggest mistake that almost anyone can make right now is waiting on the sidelines. If you're buying, if you have a mortgage, if you're renewing, the worst possible thing that you can do right now is dig your head in the sand and say everything will be okay. Because the truth is, even the BOC has no true outcome. And if they feel like that's the case, then you should be careful and proceeding with caution. If you don't feel like you're getting that type of advice right now from your mortgage broker or your bank, which you're probably not, let's be honest, click the link in the description below so we can show you how we send regular monthly updates to our existing clients with custom analysis on their equity, their mortgage, and where things are going. And if you found this video helpful, leave a thumbs up and subscribe for the next one. Hit that notification bell.